very good morning, right? Thank you for coming to this seminar, right? Okay. Today's topic, there are some of you still settling down, but I will carry on. Today's topic will be about the basic of fundamental analysis, right? Okay, let me introduce myself. My name is Mu. I'm from UOB Hian Investor Center, right? If you want to contact me, here are my contact details, okay? Okay, today's topic will talk about how to analyze stock using fundamental analysis, right? These are the contents. Okay, number one, what does investment mean, right? Basically, investment means to get returns of your assets, right? Through two ways. Number one, capital appreciation. Number two, a steady income, right? A lot of investors have ignored the second part, right? Actually, steady income in terms of dividends or interest is also a component for increasing your wealth. Well, as you have already known, there's no such thing as risk-free investment, right? Okay, how do you start? Just briefly run through. Number one, you need to know your own risk profile, right? Need to know yourself. What kind of risk you can afford. Step two, you need to know about the risk of the product, right? Before you buy any investment product, right? You need to know how risky is this particular product. Step three, right? You are supposed to match and build your portfolio. So you will only buy those products, right, that you can afford the risk, right? And through a systematic and prudent way, you will build your own investment portfolio. Okay, how do we analyze stock, right? Basically, there are two schools of thought. The first one is fundamental analysis. The second part is technical analysis. Today, we will focus a bit on the fundamental analysis. For technical analysis, of course, we have some videos online, and we will have some seminars, right, from Monday onwards at UOB Hian Investor Centers. Okay. Basically, what is fundamental analysis? Okay, basically, you look at the factors that are affecting the stock prices. You have number one, the external factor, the economical factor, and number two, you have the internal factor, right? Basically, like the accounts, right? The management, the companies, sales tactics, and things like that, okay? The aim of fundamental analysis is to derive what we call a fair value, okay? If the current market price is below this fair value, you will buy. If it's above, you will sell, okay? Since there is a fair value, it can be estimated. How come the stock prices can be above or below this fair value, right? Basically because of fear and greed, right? So when the market is panicky, when the investor is in the fear mood, the prices will come down, right? Of course, the reverse is true for greed. When investors become too greedy, the stock prices will become a bit more expensive. So, a smart investor will have to know where is the market now. Is it in the fear phase or in the greed phase, right? Okay, let's go into the approach of fundamental analysis. We use a top-down approach, okay? Basically, from the economical trends, right? Economic data, right? You will have to find which country is performing the best, right? What is the implication on the stock market? Using it to predict the market direction, right? After that, we go into so-called industry analysis, right? Within this country, which industry will perform the best, right? And of course, you need some data to support that analysis, right? Finally, within that sector, right, you will choose the best performing company inside that sector, right? So first, you choose the best economy, best sector, and best company, right? And how do you do that? Okay. Basically, business cycle and economical cycle will drive the stock market, right? Traditionally, we are saying that the stock market normally is 6 to 12 months ahead of the economy, right? This stock market performance is an indicator, right, to give a clue of the future trend of the economy, right? But there are 3 types of indicators in the market. First one is the leading indicator, which can help you to predict the economic trends, right? The lagging indicator and the coincident, okay? Normally for analysis purpose, right, we will focus a bit more on the leading indicators. Okay, what are they, right? Things like PMI, Purchasing Manager Index, right? Manufacturer new order, right? Even the stock market index, yield curve, money supply. These are leading indicators, right? Of course, coincident, you have the GDP, industrial production, right? And even the retail sales, right? To confirm your prediction, of course, you can use a lagging indicator, the unemployment data, right? And the inflation index, basically the CPI, Consumer Price Index, right? For today, right, due to the limited time, we will focus a bit more on the leading indicator. Okay. The first one we will look at is PMI, right? Basically, it's a survey of all the purchasing manager, right? It's a forward indicator of manufacturing activities, right? How you read the index, right? If it's above 50, it means the manufacturing activities is expanding, right? If it's below 50, it means it's contraction, right? So if you have an index of 59, right, which come after, for example, last month you have 51, and this month you have 59, means it's expanding. And how do you get this data? Okay, from this website, www.sipmm.org.sg. Okay, this website will give you the Singapore PMI. Okay, the next one we can look at in Singapore is what we call the Composite Leading Index. Okay, what is it? Okay, it comprises of 9 different components. Basically, the US PMI, stock prices, new companies formed, right? The stock of finished good, liquidity, etc., etc. Okay, the purpose of this index is to help us to try to anticipate, right, the economic turning point, the market turning point, right? It will track quarter to quarter percentage changes. And where can you get this data? Right? It's from the government website, mti.gov.sg. Right? Okay, this is how the composite leading indicator will look like. Okay. The continuous line that you see over there is the STI, right? And the CLI is the dotted line, right? So you will see some correlationship. After looking at the macro figure, the external data, you have to also zoom in and look at the financial statement, right? So there are 3 key components, right? The income statements, right? So which tells you how much the company is making, the profit and loss statement, basically. The balance sheet, how much does the company own or owes, right? How much asset does the company have or liability, right? And also the cash flow, the inflow and outflow of the cash, okay? Let me go into a bit more detail. Okay, for income statement, there are so much data inside there, right? For us, we are all very busy people, right? So we will look at these few more important figure. Number 1, the growth of the profit, right? What's the profit trend? Is it growing, decreasing, or whatever, right? And you compare it with the competitors also, right? What is the gross margin or net margin? Basically means the net profit or gross profit divided by the revenue, right? Then from shareholder points of view, what is the earning per share, right? You take this net profit, divide by the total number of shares, right? So for income statement, we look at 3 things, right? The growth of the profit, the profit margin, and the earning per share. Okay. The second item is the balance sheet. Basically, what is it? Okay, in the balance sheet, you have asset, right? Then you have liability and equities, right? How it goes is, for example, if your asset is a house, right? How do you buy a house? You can use your own money or you can borrow from the bank, right? So the asset have to be equal to liability plus equity, okay? Basically, this is what a balance sheet is all about. Okay, same thing. There are a lot of data inside the balance sheet. What do we look at? Okay. From investment point of view, right? We look at the debt to equities ratio, right? We want to know for this company which part, how is the growth being funded? Is the company growing because of borrowing? Is funded through debt or is it through shareholder equities, right? if you believe that 2013 will be a tough year, right? Economy might slow down, then debt to equities ratio will be very important. Because during a crisis, right, company with high debt is more likely to get into trouble, right? More easily than a company with lower debt, right? Basically, the calculation is, right, total borrowing divided by total equities, right? For me, I'm using total liabilities. Of course, some of them will use only long-term liabilities, okay? This is debt to equity ratio. Then from a shareholder point of view, we want to know what is the return based on shareholder equities. The calculation is net profit divided by total shareholder equities. So we are calculating the power of profit generation of this company, right, vis-a-vis the shareholder equity, right? From shareholder point of view, is this company good at generating profit, right? Okay, book value per share, basically the equities divided by total number of shares, right? So you want to know from book value, what is the book value per share versus the price that you are paying for this company. Okay, other than these two statements, okay, we also look at some stock valuation ratio, right? Of course, there are things like PE ratio, price earning ratio, price to sales, price to book, right? A ratio, a single PE number by itself is a meaningless number, right? You must compare PE, company A with company B, company C in the same industry, or compare with the industry average. If not, that PE number is a meaningless number. But nevertheless, there are some magic number, which I will tell you later. Okay, PE, the most commonly used, basically is the share prices, share price divided by the earning per share, right? In layman terms, it means how many years will the company earn back the price that you pay for this company, right? Layman term, okay? The lower the PE, the better, right? Okay, since the lower the PE, the better, how come there is some company selling at very high PE, right? This is because the market is expecting the company to grow faster. That's why they are willing to pay a higher PE, right? So you have different company with different growth rate, right? How you equalize it, right? So there is a new term called price earning growth, PEG, right? How you do it in terms of calculation is the PE ratio divided by the estimated EPS growth, right? For example, you have a company with a PE of 10, growing at a 10% rate every year. You will have 10 divided by 10, which is a 1 PEG. So, what is the magic number? The magic number is 1, right? Hopefully, we can find some company with PEG less than 1, right? Versus company with PEG more than 1. Because by using a PEG, you have taken into account the growth rate of this company, right? Is it something that cast in stone? No. right? It's just a reference number, right? So, a fairly valued company, right? If is now trading at a PE of 10, should be growing at 10%. Basically, that is what do I mean by PEG of 1, right? And where do you get this number, right? Okay, basically, UOB Hian website, utrade.com.sg. Okay, that is from the earning side. Then from the price to book side, okay, you need to know how much for this price that you are paying, right? How much is it is in terms of book value belonging to the shareholder, basically the price to book, okay? And return on equities, right? Basically also measure the growth of the book value, because profit after deducting dividends will add to your book value, right? The purpose is to look for stock with low price to book but high ROE, right? So who is the expert in fundamental analysis? If you think it's the guy on the left, Kichu. If you think it's the one on the right, Kichu. Sorry, I'm not trying to make fun of a certain minister, okay? Okay. The one on the left is the third richest man in the world, okay? The one on the right is the second richest man in the world, Bill Gates, Warren Buffett. But today, we are learning from the third richest man in the world, not the second. Why? Because for Bill Gates, he's rich because he have this company called Microsoft, right? He grew the company very well. He is good at doing business. But today, I'm not teaching you how to do business. I'm teaching you how to invest. And the business for Warren Buffett is that, right? His main business is to put money into other people's business, right? Investing in other company, right? Hopefully, you can be as rich as Warren Buffett. Okay, what does he look out for? Okay, he wants to know whether the company is performing well consistently, right? He look at return on equity, ROE, right? He compare it across the industry. He look back 5 to 10 years. Okay, so ROE. The second thing he want to look at, does the company have avoided excess debt, right? Some level of debt is okay for the company, right? So he look at debt to equity ratio. Is this amount controllable, right? Is the earning growth generated from shareholder equities, or is it from borrowed funds? The third ratio he look at is operating margin, profit margin. Is it high? Is it increasing? Same thing, you look back 5 to 10 years and you look horizontally, compare it across the industry. Right? He also look at some other things that you don't see from the financial statement. Basically, how long have the company been listed, right? Is it more than 10 years, right? Because nowadays, crises happen a bit more often. Previously, you have to wait for 10 years to get one crisis. But now within 10 years, you can have more than one crisis, right? And what happened to this company after the crisis? Is it getting stronger or getting weaker, right? Does the company products rely on a certain commodity, right? Is the company having a product that the competitor cannot match, right? That the competitor cannot replicate the competitive advantage, right? The wider the moat, right, the tougher is for the competitor to get into your market share, right? By the way, the moat is something like a protective river that surround your property or your castle, right? The wider is it, the more difficult for your competitor to eat up your market share. Finally, is the stock selling below the real value? And what is the real value? According to Benjamin Graham, this is the formula. Who is Benjamin Graham, by the way? Anybody know? Okay, Benjamin Graham is the professor of Warren Buffett when he's still a student at the university, right? So he's the one who come up with this idea of value investing, right? The formula is 22.5 earning per share times the book value per share and the square root. Why 22.5? Because he thinks that the magic number for PE is not more than 15, 1.5. And the magic number for book value is not more than 1.5, 1.5 times. So 15 times 1.5 is 22.5, and to get an average of two numbers that you multiply, you square root it, right? In a bull market, it's a bit tough to get any share prices that is below this Graham number. Tell you that. But during crisis, yes, you can. If you find any blue chips that is trading below the Graham number, right, it's worth looking at it, right? And I have mentioned all these different ratios and different number. Where can you get it? Of course, it's UOB Hian website, utrade.com.sg. And how do you do it systematically? Let's say I would, after my analysis, I have decided that the banking industry is the best industry for me to invest in, right? Then the next question is which bank stock, right? So I will come up with this table. First is the income statement items, basically the three of them: net profit growth, margin, and earning per share. The second part is the balance sheet item: debt to equity ratio, ROE. The third part is the stock valuation: PE, PEG, price to book. The one with a green color means the higher the better. The red color means the lower the better. So you will go to this website, extract all the data, put inside this table, right? Those you think is the best, you'll put some color, your favorite color, let's say blue color, right? Then you just look which of them have the most blue color, right? That will be the stock that you can look at, right? But nothing is cast in stone, right? You can add additional ratio or other thing that you want to analyze inside this spreadsheet, yeah? So, from one look, you know, right? UOB Bank have the most number of blue color, right? Basically, from a normal investing methodology, right? You can use fundamental analysis alone to decide what to buy, right? But you can also combine FA and TA to decide. FA will tell you what to buy. TA will tell you when to buy. So after deciding what to buy, maybe you want to look at the chart, right? And decide when is the best time to buy this. I give you another example. For example, you have discovered that telco industry is the best. Then again, you do the same thing, right? And you come up with this number. Somehow, Singtel got the most number of blue color, right? So, Singtel is the answer to what to buy. Then you look at the chart, right? And go in at the right timing using technical analysis. Okay, in conclusion, right? For economic indicators, right? Most of the time, we will be looking at the leading indicator. Basically, the PMI, Purchasing Manager Index, and the CLI, Composite Leading Indicators, right? Okay, for the financial analysis part, okay, we look at the income statement and balance sheet. Basically, the margin, the earning per share, the debt to equity ratio, the ROE ratio, the book value per share, right? On the valuation part, we will look at the PE, the price to book ratio, right? We want to look for stock with high EPS growth but low PE, right? We can try to look at the PEG, right? Hopefully you can find something that is below 1, right? And also we like to pick stock with low price to book but high ROE, right? Okay, that's the end of my seminar. Thank you.